Have you ever felt life is going swimmingly and then all of a sudden, bam, an accident, a job loss, a health scare, something knocks the wind out of your sails? That's risk. Risk doesn't knock. It shows up unannounced. Let's talk about that. Hey everyone, I'm Marco. I'm a licensed agent in the province of Ontario, and this is Making Better Sense, where I sincerely hope that we're going to be able to demystify how money works and make sure that everyone out there knows exactly how money works so you can make better decisions when it comes to your personal finances. As most of you are gathering, personal finances is a bit of a passion for me. So today we're going to dive into something that most people ignore until it's way too late. Risk. And it's not the scary kind, but the sneaky kind. Now, a little bit of a disclosure here. This is not financial advice. I'm here to provide examples. This is an educational video. You want to be able to sit down with your advisor and decide upon your finances after completing a needs analysis or an investor profile assessment. So let's make that clear. With that out of the way, let's talk about risk. What is risk? Short definition is that risk is exposure to uncertainty. It's not always bad. We get up in the morning and we have risk. We go outside, there's risk. We cross the road, there's risk. We enter into a relationship, whether it's a personal relationship or a business relationship, well, that's risk. We're putting ourselves out there, right? But then there's risk and then there's risk, right? Smart risk is where we can manage it. Blind risk, well, that's when you ignore it or make foolish decisions. So let's dive into that. Now, apart from personal risk of putting yourself out there emotionally and all of that good stuff, when it comes to our finances, there's 4 key risks we want to be able to identify. And the first one is risk of premature death. We don't like talking about it, but what happens if we were to pass away prematurely and we leave behind loved ones who depended on us? That's a key risk that one has to consider in life. But how about illness or disability? If you're trucking along, earning money, getting your paychecks, and then all of a sudden you suffer some misfortunate illness or disability, well then how do you continue making a living? How do you provide for your family and children? Now also in this day and age where everyone's living a lot longer, there's also a very real risk of longevity risk. Outliving the savings you have. Now you can try hard to try and save as much as you can. Sometimes we're going to live so long that we are going to outlive our savings. That's a huge risk for some people. And then a lot of what we are going to talk about today is as well part of the investment risk of market and investment risk, right? And that's when the market fluctuates. Will your investments perform as well as you hope they do? Will you have enough money later on? So that's a big risk. So as you guys know, I've got some pretty extreme friends. Mario Meatloaf is no exception. Now, Mario's an extreme. He's 58 years old. He cashed every paycheck and he put every paycheck in a safe at home. He wanted to put it in a safe so if something happens, a flood or a fire, he felt safe. He doesn't trust the banks. He wanted to keep all his money, as you say, under the mattress, but in a safe. And what's wrong with that? Well, first off, inflation is wrong with that. With inflation being 2.4% last year, that means every year Mario's money loses its purchasing power. He's able to purchase 2.4% less next year than he is this year because his money isn't growing. It's being stagnant. Secondly, Mario ended up going out of town. He wanted to visit his family. While he was away, something unforeseen happened. He was burglarized. People came in. They stole the safe that had all of his life savings. Mario lost everything. So even though Mario didn't trust anybody or didn't trust the banks, he was very risk averse, he still lost everything. We're going to visit another friend of mine, Mandy Marinara. She's 38 years old. She's cautious, but she's not like Mario. She wants to be able to put it in the bank, but she wants to keep it very, very, very safe. She doesn't want to risk. She doesn't want volatility, no fluctuation. So for her, her mom always told her, keep everything in the bank, similar to how my mom used to be. The bank only pays 1%. I've said this a lot on my last few videos. The bank only pays 1%. So what's the real risk there? Inflation isn't going to affect her as much as it affected Mario. But at 1%, with the inflation being 2.4, that's still a negative 1.4%. Her savings will slowly erode over time, continuously losing her buying power. You know, the risk of slow deterioration is very real for millions of people. So her money just didn't grow as much. All right, here we're going to meet a real character. Larry Lasagna. Now, he's in his 30s. He is a gambler. He's a total risk junkie. He's very ambitious. He is very concerned with making as much money as fast as he can. So he invests directly into the stock market. Now, every once in a while, he buys a couple of really decent blue chip stocks, waits for them to go up, he sells them. But for the most part, he likes these penny stocks that if they go up a couple of cents, it kind of doubles in value, and he doubles his money. And he's actually done quite well over the past couple of years, and he's amassed a little bit of a fortune. But until one day he hears about this big tip from someone at work that this mining company was going to be releasing the fact that they had discovered a new ore in one of their mines. Larry took all of his money, bought that one stock, and was hoping to get a large payout. He was going to retire immediately once he got this big payout, and he kept checking the stock every day, and it went up, and then all of a sudden, they did their quarterly review. And then all of a sudden, they announced that they were laying people off, they were closing mines, they were in financial difficulty for whatever reason there was. And then things were so bad financially that they delisted the stock. Anyone that had public shares, they were in a buyback program. Larry got 5 cents for every dollar he invested. Larry was ruined. He was ruined. He lost it all. Larry didn't invest. He gambled. All right, we're going to meet our final character today, Rosalie Ragu. Now, Rosalie is 24. She knows what she doesn't know, so she sat down with an advisor. The advisor asked her a lot of questions with regards to her finances, her risk comfort level, and they together came up with a plan. Rosalie took a little bit from every paycheck, started investing it. She chose a broad spectrum funds like mutual funds or segregated funds that invest in many companies all at once. So if one company does poorly, the other companies will bolster it. So she used that as a strategy to minimize her risk. Now, they went up and down, those funds, and that's fine. They decided to pick a little bit more volatile, a little bit more aggressive funds that showed a little bit of volatility, but definitely were poised for growth over the long term. This maximized how they grew over time. Since she was young enough, she can let it ride. She also invested in insurance policy, a good universal life policy. She began to over-contribute to increase that cash value within that insurance policy. Over time, her and her advisor would meet and they would revise their strategy. She bought a house, had kids, her and her partner got married. But as she grew older, she got into her 30s and 40s, they decided to invest in less aggressive funds and more balanced funds, which balanced the growth and the stability of the fund. As she got into her 50s, they changed again and started going into less volatile funds, more stable funds that had a better return, a safer return, instead of having those volatile stocks. Now, Rosalie knew she couldn't eliminate risk. So what she chose to do is she chose to manage the risk. She chose a balanced approach to accept the risk and then balance it out. All right. All of these examples are very extreme examples. I get it, right? But we all know a Mario that doesn't trust. So which one are you? Are you a Mario that doesn't trust banks? Are you a Mandy that wants to play it safe and sound? Are you a Larry that tries to risk it all? Or are you a Rosalie that takes a balanced approach? Maybe you're just the person that says, I'm going to wait until later. That's risky too, because later doesn't send a calendar invitation. Speaking of later, let's talk about insurance. Full disclosure, that's what I do. But it's important because insurance is the foundation of all financial plans, yours and mine. I can't even begin to tell you how important it is. What happens if you can't work tomorrow? What happens if you pass away prematurely? If you think of it as a house, insurance is that foundation of the house. Everything else, your savings, your emergency fund, that all becomes the floor, the walls, and the roof. But your insurance is the foundation, is that just in case. Without it, the whole house of cards can come crumbling down. The storm can blow everything away. I hope this video made you think. I help families like you every day help protect their wealth and grow their wealth. This is important stuff. Without a good plan, we all run the risk of not having enough, not being enough, not helping our families enough. So this is really important. If you know someone that needs to hear this message, please send them this video. If you have questions about risk, reach out to your advisor or reach out to me and ask a question. I guarantee if you have a question, there's 20 other people that probably have the same question that you do. Even if you're just here to learn, do me the favor, hit like and subscribe. There's more videos coming up. The biggest risk is doing nothing. I'm Marco. Let's make better sense together. If you want to know my 5 money myths that just might be keeping you poor, click up here. If you want to know how compound interest works, click this one.